fast after the new regulations. And what we've been seeing on the field is that many of the MFIs and others want to know more about the income assessment part and issues of over-indebtedness, and especially what kind of policies to set within their organizations. So just as a background, as you know, Sa-Dhan has been sort of engaging with RBI for last 4-5 years on a new set of what used to be called activity-based regulations, where we were recommending uniform regulations for all players in the field. So we're happy it took some years, but everybody is on board now. And in anticipation of that, we had also come out with a credit assessment tool, which some of you may be familiar with, but in case you want to know more about that, then we'll be happy, our teams will be happy to send it across to you. Some of our members are using it already in the field. So it essentially looks at income expenditures of households as well as their assets. There are proxies for poverty measures, and it also includes their credit histories. And I think a lot of people have found it very useful. So before we invite the panelists, just to understand what's been happening in the field the last 4 months, there is some good news and there is some worrying news. Overall, in terms of the performance, I think things are looking good. Collections are up. Disbursements, I'm told, just in the months of April and May are about 24% higher than the 3 months of the previous quarter, the last year quarter. And I think a lot of MFIs have already put in systems in place. There has been staff training going quite regularly. However, on the other side, the flip side is that we are hearing a lot of credit bureau rejections. 3 months of the previous quarter, the last year quarter. And I think a lot of MFIs have already put in systems in place. There has been staff training. I'm sorry, there was some recording which was playing in the middle. Sorry about that. Okay. So the good news is, yeah, and even on the, I think we do some analysis in the sector, and we're seeing that are of course coming down, which is a great thing. And even the over-indebtedness parameter, which is in the earlier days, we would look at clients with 1.25 lakh loans amounts above. So that is also down to about 2.4% as of now, which is about 14 lakh clients. So which is all good news. However, some states, some districts in West Bengal, Assam, Tripura and all are still slightly on the higher side. Now, essentially, as I was saying, the worries tend to be more on the high rejections from the credit bureau side. And also we've been told that some of the fill rates in the credit bureaus on the income side as well as the retail loans are not coming in as much as one would have liked, but we hope that over the next few months, these things will settle down. So the purpose of today's webinar really was to discuss what is happening on these two fronts, at least on the income assessment and over-indebtedness. What has been the progress made by some of the players in the field, what challenges they faced, and what can be done better. And especially many of the middle and smaller MFIs tend to learn a lot from these sessions. So I think this will be very useful. So I would like to introduce our expert panel today. So we start with Purvi Bhavsar, who will also be our moderator. And I'm sure a lot of you are familiar with her. And she's essentially MD of Pahel Financial Services. We have Mr. Sa-Dhan, who is the CEO of Muthoot Microfinance. And we also welcome him. He's as our board member in the last AGM. He was elected and on the Sa-Dhan board. We have Sachin Sachdev, Vice President, Sector Head, Financial Sector Ratings, ICRA. He's also there to give us the perspective from the rating agencies. We have Mr. Cheladurai, Senior Vice President, Equitas Small Finance Bank, to understand what the banking side is perceiving from this. And finally, we have Divya Mirchandani from Equifax, who's the Credit Bureau Products Lead. And after the panel discussion, I think there will be a presentation by Telerifin, which is a tech arm and is doing some wonderful news customer solutions in this space. It will be quite useful. So I'd like to start off by welcoming Purvi. Purvi, please come in now and share some thoughts, and then you can start the session.
Okay, thank you, Somesh, and very good afternoon. A very warm welcome to all the speakers and all the participants and Team Sa-Dhan. I will just start by saying a couple of things about this new regulation. While most of us are aware, but just as a background to what we are going to be discussing today. So RBI has come up with this new regulation in March 2022, and wherein RBI has made an effort to provide a very harmonized framework for all the regulated entities with respect to microfinance loans. When we are talking about the new regulation, I also want to briefly remember the first regulation, that had come in the aftermath of Andhra Pradesh crisis, which actually helped this entire microfinance industry. It helped shape up this entire industry, from being a very unorganized industry. Then microfinance became a very well regulated industry, and this new regulation is expected to play a very important role in taking this to a new level, particularly in the post COVID scenario. So with this as a background, I also want to put in a word of appreciation for Sa-Dhan for two things. One is coming up with very relevant subjects. I remember myself attending the last webinar on the fraud. That was also very useful. And coming up with a very thoughtful line of speakers. Actually, I'm so glad that we have a representation from NBFC, MFI, SFB, credit rating agency, and the credit bureaus, and somebody representing technology also from Kaleidofin. So I will start this session without wasting too much of time on the background. And I will start with Sadaf. So Sadaf, we all are aware that, as per new RBI directive, the lenders have to come up with a board approved policies on income assessment and indebtedness cap. So I just want to understand what are the kind of challenges this new regulation brings on table. Maybe you want to explain this from three important angles, from technology, from people, from customers or market, and then share some of the best practices that you have already implemented. So over to you, Sadaf.
Yeah, sure. Thank you. Am I allowed to share a presentation? Just wanted to kind of share something.
I think we can do that. Shall we make you the host?
Yeah, okay. I think I can. Okay. Is it visible?
Yes, it is.
Okay, I just quickly wanted to set the context. Thanks, Purvi, and thanks everyone. Thanks, Sumesh, for organizing this and inviting me to speak. But just to set the context, I think Purvi has appropriately covered this. But before I get into the challenges, I just wanted to kind of appreciate the effort that Sa-Dhan and has put in, and all the associations have put in to get the problems of ours conveyed to RBI, and then also appreciate RBI's effort to come out with these challenges, this regulation, which is really, really positive. I think there are 3-4 key changes which have been made, which are really, really positive for the industry. First is like household income, which is the biggest thing. Earlier, we had restriction of 1.25 and 2 lakh rupees. Now it has been increased to 3 lakh rupees, and it's uniformly increased across the rural and urban geographies or semi-urban geographies. So it actually increases the market size a lot for MFIs. It defines where the target area is there for MFI. So that's a great positive that has come out. The second is obviously the rate cap removal. Obviously, that helps us to price our credit appropriately, ensures that even the smaller MFIs who are facing challenges of cost of fund and margin, that they are also able to appropriately price. Of course, this has been done keeping in mind that the industry is evolved now. There is a SRO in place and people are responsible. There would not be usurious interest rate, and we should be all responsible for that. But this is, I think, by far the most reformative initiative that RBI has taken to ensure that we have the liberty to decide at what price we lend, and at the same time decide which area we want to operate and price according to our risk. So that is one great thing. Apart from that, I think from a risk management perspective, there are two things which have happened, which are very great, in my opinion. One is the implementation of FYR. I think previous regimes, we were doing underwriting, but those underwriting or the credit assessment was not really up to the mark, because you were looking in a very isolation that only MFI loans or only SFBs or only microfinance loan. But an obligation of a household is an obligation, whether it's a two-wheeler loan, whether it's a housing loan, whether it's any other form of loan. The money has to go from the household, and that should be taken into consideration, which I think earlier, because of the regulation or probably the way that we underwrite, we were not taking. But now RBI has imposed an FOIR regulation uniformly, and that will ensure that we take all the obligation at the household and underwrite a customer. That I feel is a true underwriting. And this will definitely remove a lot of risk that comes from lending into this segment. So that is, I think, a great initiative. Again, as Purvi said, and this was the aim of RBI, was to harmonize the regulation. So I think that itself is a big plus, because the challenges that we faced in various territories, namely Assam, because of, I think, regulatory arbitrage, and there were different regulation applicable to different type of entities, that has been taken away. So this again kind of insulates a lot of risk for this sector. So I think this is, all in all, in my opinion, is a great initiative by RBI, and this is a watershed moment, and we should celebrate it. But yes, again, this comes with a lot of challenges, which have been asked by my co-panelist and Purvi to highlight. I wanted to share those challenges. The first thing that we want to understand is, what are the key changes? So key changes are, there is a concept of household income, which needs to be assessed, and household income has been capped at 3 lakh rupees. So I think right now the lot of people are struggling how to calculate the household income, whether to include only the spouse, whether to include children, their income or not. So that is something that has to be kind of understood. What we have done is we have made a board approved policy where we consider household as their husband, wife, and their unmarried children. And if there are any of the unmarried children is earning, then that is income is taken into consideration as a household income to qualify for the 3 lakh. If that goes above 3 lakh, it's a non-microfinance loan. The second concept is FOIR, which is fixed obligation to income ratio. This is again keeping in mind all the obligations that are at the household level. This obviously kind of leads to a assessment of the household as a unit. So you have to take a credit information report for not only the client but also the spouse and other earning member. That's the policy that we have adopted, that we have to we take a credit bureau report for all the members, earning members in the household, and obviously we have to take consent of all the people, and we take all the obligation of the household into consideration, which is all microfinance obligation, all consumer loan obligation, or any other obligation that the customer discloses in her personal discussion, which may be of the fixed nature and are kind of a loan obligation, not the obligation of rental and other things. Those are not. So RBI has put a 50% cap, assuming that rest 50% would be utilized for meeting the household expenses, which are of other natures apart from the fixed obligation. The fourth thing is basically pricing of credit, and pricing of credit has components which are cost of fund, operating cost, your expected margin, and obviously a risk premium. These are things which need to be taken into consideration. And when we are calculating an obligation of a customer, we have to take this obligation also into consideration, which is going to come from the EMI that we offer. And fifth, and the very important initiative, which is from the perspective of a customer and bringing transparency into the sector, is to give the fact sheet to the customer, which entails every deduction that we have made out of the loan, and calculating exact IRR for the customer, that at what rate she is getting the loan. So I think these are key areas around which I'm going to talk about, and these are very, very key element. These are something new that has come in. Probably the pricing of credit was there in some shape and form, but the risk premium is a new thing. That is something which has come in. And risk premium for companies which are following ECL policies, India AS, may be easier to assess, but for people who are not following India AS or not doing an ECL calculation would be a little bit of a new area to look at. But definitely, I think there is a freedom to price. But the best part about all of this is a liberty that RBI has given, that everything has to be as per the board approved policy of the institution. So institution has been given the responsibility to put the policy in place to implement all of this. The challenges that come in, obviously, the biggest challenge with the new regulation was the original timeline of implementation. So the policy came in on 14th of March. And we were supposed to lend from 1st of April with these regulations. So this was something which was tough. And I think there were representation made. So good part is we are coming in a time where already there is an FAQs which were released by RBI, and they have given time till October for this to be implemented. But anybody who is able to implement it earlier, that is great. So that is something. Apart from that, I think apart from the timeline, the biggest challenge is because this is a very, very large change that has come in place, the way we lend. There are IT changes which are required, which may require LOS changes and LMS changes also. Many of the institutions depend upon external third-party vendors for their IT requirements. So to get those changes kind of implemented in their system will take time, and which I'm sure most of the people are doing. And people who are already having their in-house system would have made changes. So this is another challenge that most of the people are facing. The third challenge, even when you are ready to implement and everything, is there are certain credit bureau related changes which are needed. Even the credit bureaus are not really ready for this report. Right now, we are using a combined credit bureau report, but even the combined credit report is not really free with flaws. There are issues in terms of, for example, the Consumer Bureau does not report EMI of the institution. It reports the obligation and the outstanding, but the EMI and certain loans is not there. While there is, as we speak, there is a committee that has been formed by RBI, consultative committee. I'm a part of it, and there's a consultation between credit bureau, banks, NBFCs, NBFC, MFI, all sorts of lender, to make sure there is a uniform methods of reporting. But at the moment, these anomalies kind of are there. The fourth biggest challenge is assessment of obligation. How do you assess all the obligations that are there? When you go and do a combined credit bureau report, you would see on the right, I have tried to highlight, there are gold loans, there are credit cards, there are Kisan credit cards, there are charge card, there are fleet cards, there are some Kisan credit card, non-funded credit facility. Those obligations will come in, and most of them are in the nature of a bullet payment, or there is no fixed installment for them. How do you take that into consideration is something that people have to decide. A business loan of agriculture nature, there are non-funded credit facility that banks give. So all of those, I think, how do you make your policy is a big challenge. And I think it's only a test of time when the RBI will look at it at various organizations, that how these obligations have been taken, then there would be an opinion that will be formed. I have also given a example below. So below, if you look at, there is a screenshot of an Highmark credit report, which gives a microfinance personal loan, and it has a loan amount there, 57,600, but there is no repayment date. It's a single payment, bullet payment loan. How do you take this loan into consideration? In MFI Bureau, we had all commonly agreed that we will disclose our names. So we knew that, okay, X MFI is lending and what is their rate and what is their product. So we can roughly calculate what is the EMI. But here we don't even know which lender it is, because Consumer Bureau, the banks have not agreed to share their names. So this is a challenge. This is a practical challenge that all of us will face when we go down and we lend to these customers. But definitely over the period of time, things will come, and I'll also elaborate how we are tackling with these issues. But these are some real practical issues at the ground that everybody is facing today. Even when people have implemented the policies, gone ahead with the change in system and tried to kind of implement these changes. Other things, I think obviously income assessment is one area which is definitely very, very important. We have to look at the income of the household, and there has to be income reporting that also has to be done. Like, we are not only required to calculate income, but while submitting the credit bureau information, we are supposed to report the income of the individual also. And next time when we lend, if there is a variation in the income, then the onus is on us to ensure that we have correctly assessed the income. So in that context, assessing the household income becomes very, very important, that how we are calculating the primary applicant's income, how we are calculating the household member's income, be it spouse or be it earning member who was there. So that has become another challenge that is there, which has to be tackled, and we have to ensure that we correctly assess the income of the household and report the income of the household. One of the things that I have noticed, again, I can tell you this is anecdotal, but all of a sudden, a lot of our clients are becoming widows. So all of a sudden, the husband is not there and the income is not getting reported. So those kind of clever tricks field operation people will deploy, but we have to ensure that we go and assess the customer in a manner that in the long run, we are in keeping with the spirit of the regulation and we implement those regulations correctly. Maybe our segment is such that we don't have documentations, but again, the personal discussion that we do has to be in the format that we are able to kind of assess the income accurately and then report the income correctly. So those are some of the challenges that you will face in terms of an income and corroborating the evidence. Similarly, for obligations, there are certain obligations which the customer would have loans from outside the regulated sector, outside the formal sector. So those also have to be correctly pointed out into the obligation calculation. How we are going about it, I'll just quickly go into that. What we are doing a upfront credit bureau check for the customer to know that what are the obligations that the customer has from the credit bureau. And we do a comprehensive credit bureau, which is the customer credit bureau, the husband's credit bureau, and the earning member. So on an average, we are pulling out 3 combined credit bureau reports. So these are not your individual credit, simple credit, MFI credit bureau report. These are comprehensive credit bureau reports, and these are 3. So we are doing that. Then we go for the verification with the customer, the personal discussion with the customer, asking her what are all the obligations that are there, and we ask her that are these all obligations accurately captured. Some of the obligation needs her input in terms of what is the EMI and stuff like that. Then we verify those obligations. Then we go for income assessment of the individual and assess whether she fits into the 3 lakh income category or she is from an higher category, because there are certain cases which have come up that the customer has a housing loan which has an EMI of 8,000-9,000. So definitely if she's servicing an 8,000-9,000 and she already has a microfinance loan also, so she might already be out of that league. So we are doing that. Most important of this is taking declaration from the customer, because we are assessing a customer which is not having documented income, and we are assessing the income based on our personal discussion. We need to take, after assessing the income, a declaration from the customer that this is her assessed income, and whatever is being assessed here is correct and accurate. and then calculate the eligibility of the client based on whatever income that we have calculated. And based on that, we are lending to the customer. So that is what we are doing. And these are some of the challenges that we are facing. Interesting time, early days. I can't say these are the kind of easiest and the simplest kind of a regulation. But yes, we will all learn along the way. But I definitely feel this is a better way of underwriting, and this will reduce risk and improve our return on our portfolio. Purvi, that's from my side. Sorry, I took more time than you allocated.
Thank you, Sadaf. Thank you so much. I know this is such an interesting and elaborate subject. And, I'm given a difficult task of keeping everybody on schedule so that, we can have an opportunity to hear them all out. So thank you, Sadaf. This was really very, very helpful. And the way I would put it is, while the regulation has given a lot of freedom, but it has the freedom with responsibility is how, as MFIs, we are supposed to be acting on most of the parameters. And I also remember, when first time Malegaon committee had come up, the report had come up, and first time when we were asked to implement the credit bureaus, it was a new word for all of us. And there were no, track record that any of our customers had, the challenges related to election card and Aadhaar card then. So from there, I think we have come a long way. And I'm sure once we start capturing a lot more data over a period of 1 or 2 years, we will have a very good track record and a very good data, which will help make our credit evaluation more meaningful. So with that, thank you, Sadaf. And I move on to the next speaker. We have Mr. Sachin Sachdeva from ICRA, and I have some questions for you.
Definitely.
Yeah, okay. So I just want to understand, how well geared you think are the lenders for the implementation of new regulation? Because I'm sure you must be talking to a lot of lenders and you must be taking a lot of update on, how they are dealing with this regulation. So if you can just give us some idea as to, what is your view on the readiness of the lenders for implementation of this new regulation?
Sure, definitely. Thanks, Purvi. And first of all, I would express my gratitude to Sa-Dhan for inviting us to give our perspective on this elaborate topic. And thanks to all my esteemed panelists and participants. So first of all,
your voice is not very clear. You will have to do something so we can hear you very clearly.
Connect the microphone. Is it better now?
Yeah, slightly better.
Okay. So I was saying, first of all, I would like to put up the perspective from which we as a rating agency see. Now, fundamentally, the new regulations, there are lots of operational challenges which Sadaf has very beautifully captured and explained. But when we look at these regulations, in fact, when the regulations were announced in the month of March, say 14th March regulations came in, then by within a week or 2 weeks, we put up the outlook for the sector as a stable. Because what we see in these regulations is that RBI is looking at the sector as a mature sector, like giving the sector freedom kind of that you can fix pricing as per your own. You can fix the policies, you can do the income assessment, and all those things has to be governed by a board approved policy. You don't need to come back to regulator to seek validation of your policies or something. The board level at the company's own level, they can fix up those policies, they can set up those practices. So it is a sign of maturity for the sector. And the two most important aspects, I would say the key, the crux of these regulations is that these two things which RBI has given a power to the sector. One obviously is the pricing flexibility, which comes with do. But apart from that, what I see is that income assessment and FOIA, these are the very two important tools which RBI has given to the sector that you can try and work according to your own understanding of the sector, understanding on the ground realities, and still avoid the issue of over leveraging which the industry had been facing so far. Because you had defined a level of limit so far, that this is the income level at an urban center, this is the income level at a rural center, which is defined by the regulation, and then you have a cap on the loan amounts. But under these regulations, when they give you right that you can assess income, you can look at all the loans and decide as per your own risk assessment that what level of indebtedness you will be comfortable at. So that's very important. But as a rating agency, we see that there is one downside also to that, because with the increased level of household income, say from 2 lakh to 3 lakh, now theoretically, if say I were to go by the current workings at which the industry was operating at, say a 2-year loan, a 22% ROI, and maximum income of 3 lakh would mean a maximum loan amount for the household coming at somewhere closer to 2.5 lakh. And now there are no time limits there, so I can increase the tenure from 2.5 year, 3 year. The loan amount can theoretically go to 3.5 lakh also. So if all these things industry players don't play in a conservative way, then it can in fact lead to an issue of over leveraging, which in fact RBI has been trying to solve by allowing or permitting this thing. Because as a lender, nobody stops me from going and assessing income at a different level. For example, MFI X goes, assesses the income very conservatively, that household income is only 1,50,000. Basis that they come at a figure that the maximum loan I can give is say 80,000 to you because you don't have say any other loan. Now what stops other MFI going and assessing the income at say 1,80,000 or probably 2 lakh, whereas actual income of those borrowers may be closer to 150 or even lower than that. So that will eventually lead to over leveraging. I understand even the previous regulation was not solving that problem. This regulation also does not provide a solution, but the positive aspect is only that it leaves open to the industry players, to the majority of the players, that you need to identify the risk properly. You need to see exactly how well you can document, how well you can assess the income. So these are the key questions which we also have raised to the MFIs with whom we have been interacting over the last 3-4 months after these regulations came in. And different set of thoughts we got from them. And as you rightly mentioned, that how well they are prepared in terms of their ability to assess these incomes, or I would say ability would be a wrong word, how prepared they are to implement these things on the ground. Because one aspect is that board has created a policy, board has drafted a policy, which is in fact for most of the entities is available on their website also, that these are the broad parameters under which we will be doing all the assessment and this is how we will be following. But the actual implementation has to happen at the ground level. The field officers, they don't understand these concepts in detail. So far, they have been going by that you just go take a declaration from the borrower that this is my household income. So I am capped at this level. I am fine to go with the loan. There was a defined element. I have to check the bureau report. There should not be more than 2 MFI lenders. So whether that criteria is met or not, I can lend or not. It was to an extent simple, straightforward for them. But now, whether it is already 4 MFI lending them, any other banker lending to them or not, still you have to find out, you have to do a working that is there a limit? Can I give more loan to the same or not? So that preparedness at the ground level, I think will take some more time to come. Whether at the policy level, you might take a month or 2, you finalize, fine tune, read the documents, guidance by the SROs, clarifications from the regulator. You can implement all those, you can set up as a policy. So policy front, I think most of the players have reached that place that they've put the policies in place. But actual implementation, even when we did some field visits, we went to the borrowers, we went to the branches, we went to the centers. So at some places we saw the field officer was still lacking that kind of, I would say, training or the understanding of the key aspects, that how well they can assess the income. On that, and second aspect, pricing, although is not at the field officer levels, a decision criteria, that is a decision criteria which has to be taken at the management level. So at the management level, you can still fairly estimate that how well they can understand the risk, what are the elements, whether it is the differentiation is to be basis your geography or the type of customer or the loan cycle or the industry in which they are operating in. There are different permutation and combinations which one can put that, and management can decide upon and simply put a fact sheet that if you fall into that particular category, these kind of interest rates will be charged. But the challenge of field officers implementing the policies as it is, what the intention is in terms of income assessment, is a critical aspect. And on that aspect, I think even industry as on a cumulative basis, on a together basis, can play a key role in defining the parameters. For example, across the entities, we found one entity which had put a detailed list of parameters. They were showing us the internal document in terms of the detailed list of parameters which they've given to the field officer, that this is a complete questionnaire. You can fill from the region perspective also. For example, if I'm going to a particular village, there I know that many borrowers belong to a dairy industry. So I typically know that if that particular woman would be owning, say, one cattle, and how much of income in that particular region could be there, and whether in that area people are predominantly selling to, say, Amul as a milk society, or say any other society, or they are just retailing it, or the majority of people are selling it to the restaurant chains. And depending upon the kind of business which a area regional manager would know better in the consultation with them, you can develop those algorithms into your systems that so and so region, so and so area, so and so industry, this should be a tentative kind of income which a homeowner would have. So those kind of questionnaires would be very helpful as a best practice to the field officers, and they will help ascertain the income at a better perspective. Now, extending the argument further, if I were to add certain elements, Sa-Dhan sir also talked about the enlargement of the market landscape, because now you can either increase the ticket size or more number of borrowers can come into the net of microfinance. That's definitely a big positive, a very ample growth opportunity lies ahead. But the challenge which I see is many different kind of players coming into the competition. Currently, you're competing with a bank, with SBF, or say within the SHG group, or whatever could be the situation, you're competing as a microfinance loans. But for example, say you are doing assessment of a particular woman borrower. She is earning a very little income. On this basis, you're doing income assessment. But say her husband is running a kirana shop, and they're using all the UPI facilities for the cash transactions. Now, basis that particular husband become a target customer for a fintech player, because all the data is in the UPI transactions and banking channel. One can see that this is a good customer. I can give them even a micro housing loan as a secured loan, or I can give them a unsecured loan. But the problem for that fintech player would be that if you assess their income into your workings, whatever be the credit scoring model, less than 3 lakh, and you're giving an unsecured SME loan, that may get qualified as a microfinance loan under the new regulation. But they don't want to call that as microfinance loan because they also have that cap of 25% of the not reaching that microfinance loan qualifying asset. So they might assess income as slightly upwards of 3 lakh, keep the FOIA low, and still distribute the loan. It is in their hands. Now it becomes challenging for MFI how you will lend to that particular woman borrower, because in the bureau data at a household level, the income is more than 3 lakh. So rejection rate for MFIs will increase, as we have seen that in last 3-4 months, rejection rates have actually increased. So these are the kind of challenges I think industry and even bureaus will take time, that with time we will solve these problems, I understand. But at the moment, these are some of the challenges which one would be facing in the industry. And there come our question that, will you be able to assess properly and avoid any kind of asset quality related issues going forward? Because we as a rating agencies are concerned about that with all these things, can industry turn into aggressive lender, which may potentially result into an asset quality issue for the industry. But if all the players play conservatively or say play fair by say set rules, or obviously you cannot call it a rule, but set defined standards, then industry remains at a steady state and we don't see any major issue with respect to asset quality in the future going forward. So that would be a brief submission from my side from a perspective that how do we see both the opportunities and the challenges coming from this set of new regulations.
Great. Thank you, Sachin. That was quite insightful. Actually, I have almost filled one page of, the pointers that you have given. A couple of things that I think as a summary to what you said is, I think very good to know that RBI is seeing this sector as a matured one. And that also means that, we will have competition from, some unplanned or not so traditional players. And as an industry, we should be ready to face those kind of competition and challenges. But I think the most important, the summary, if I have to put it, of what you said is discipline at an industrial level is something that is must, unless we all follow the rules properly and we ensure that we follow the rules in true earnest, asset quality issues might be there if you go overboard and if you ignore those indebtedness related signals. So Sachin, thank you so much. Thank you for a very good insight on that. And next, I have Mr. Chelladurai. And I have a lot of questions for you from the SFB point of view. So Mr. Chelladurai, when we talk about harmonizing of rules and everything, we are typically talking about, some of the players who had advantage over the others. So SFBs were one, SFBs were not earlier regulated by those typical credit bureau related rules and a lot of other things. So, now since it has moved to entity-based regulation, the activity-based regulation, how is new regulation impacting the SFBs? What is your first feedback or reaction to this new regulation? If you can share that with us.
Very well. Actually, SLBs were most of the SLBs except one, everyone transitioned from a microfinance company to a small finance bank.
Yes.
So though earlier it was not mandatory for SFBs to follow certain guidelines like, whatever, which are qualifying asset norms, which are applicable for NBFC MFIs. But more, since, we are operating in the same customer segment. Okay, so most of the SFBs were following almost most of the criteria, not necessarily 100% of the criteria, but most of the criteria were being followed, like the number of lenders, over indebtedness, income limit, because your PSL limits or PSL eligibility is based on the income limit. So most of the SFBs are following the norms. Hence, implement right now. Whatever the new guidelines are completely new. Earlier it was more granular, more parameterized. The number of lenders. This is the limit. So likewise, it was more granular. But now the new guidelines are different. So it was both challenging for NBFC MFIs and SFBs as well as banks for banks also. But we didn't find it much means. Because of this regulation, there is no fear that, okay, we will lose market share or his implementation is going to be very difficult. So those kind of challenges were not there. But there are two, in the implementation, there are two things. One, your system level implementation. Another one is the field, people level implementation. Though earlier, even Sachin was also talking about these points. In microfinance, everything is parameterized. You put all those rules in the system. Even a field staff, if he wants to make any mistake, he will not be able to do it. Only if the customer meets all those criteria, like we do eKYC, then we do CP check, and the lender norms and all those things are configured in the system. If the customer is eligible, only then the customer would would be eligible for the loan. So field guys doesn't have any say except selecting the customer and doing the CGT GRT formalities. But right now, the income details, even now, large part of the circular, we can parameterize and put it in the system. We can put system controls, but still, assessing the income is a open point. Earlier, everyone was 2 lakh income. Now, suddenly everyone will become, every household, even the same customer when he's coming for renewal, their income would become 3 lakhs. So people play around. So Sa-Dhan was also mentioning that those challenges, and how to ensure or how to train our guys, field guys, to capture the income correctly. So that is the challenge. That is across, even irrespective of the legal status. Everyone is facing those challenges.
Okay, but do you think this new regulation will help you in developing new products and coming up with something, some innovation will happen, because you are sort of compelled to follow certain rules which you were not following earlier? So will that bring in some innovation?
Yeah, of course. See, right now the guidelines are broader. So there is a broad limit, like 3 lakh household income, and there is a clear definition, overall part of the household. And FOIR also the maximum limit has been given. Now we have complete freedom to play around. Earlier, microfinance means largely group loans and women focused. But now, it need not be it need not be a group loan. It can be an individual loan also, or it can be a digital lending product also. And even it can even we can include men also for various products. So it gives a lot of flexibility. And now the industry itself is moving to combined credit report. So we have credit bureau scores now, which are available, and even based on the purpose. Though we can lend it for various purposes, but now it is giving a lot of freedom to design a product based on the purpose. So it can be a consumption loan. Mostly the microfinance loans are named as income generating loan or business loan, something like that. But now no more, we need to restrict to only income generating purpose. As long as that loan is used properly, I think should be fine. So definitely, it gives a lot of flexibility, to design various products. But at the same time, though this segment, RBI has considered this microfinance segment as mature segment and relaxed all these norms, but still this segment is vulnerable and susceptible to exploitation. As all mentioned, there is a coordination and discipline required at all lenders level. Because even if you look at the credit bureau or various industry reports, ticket sizes above 75,000 has higher delinquency ratio than the lower ticket sizes. Okay, so right now, Sachin also given a calculation of the maximum eligibility can be 2.5 lakhs. And if the tenure is increased, even it can go beyond that also, because right now there is no restriction like 2 year only, your loan should be there. It was a part of earlier qualifying asset norm. But now, people can go 3 year, 4 years tenure just to increase the loan. So if that happens, our segment, I would say, still not mature. So we have to handle it with care.
Sure. And I just can't resist but ask one last question. Why do you think, would you like to share some reasons for why the SFBs and banks have higher PAR in their portfolios in comparison to NBFC MFIs? And that's the trend that we have been seeing for quite some time, particularly during this COVID time, and that continues for a while. So would you like to share any insights on that point?
Though the legal entities are different, like SFBs, banks, even in banks also the microfinance department is separate, and the people, the kind of people we recruit, they are at par with, across NBFC MFIs or NBFCs. People, the field staffs are, of similar quality. Mostly products also, if you look at, similar. Okay, not much of differentiation, and even the systems, processes, more or less, everything is same. So within the customer segment, the portfolio behavior across legal entities, would be similar. Okay, so that is my view. So there cannot be any difference in the portfolio quality because of legal entity. But your question comes, if you look at industry reports,
Correct.
If you look at SFBs and banks would have been maintaining better portfolio quality. But post pandemic, banks and SFBs, the portfolio quality or the PAR numbers are higher compared to NBFC MFIs. But it is due to various other factors, like the individual strategy on or the write-off policy based on that. So if you look at the banks or universal banks, mostly they have written off, their write-offs were comparatively higher during the last 2 quarters. But NBFC MFIs, if you look at, they are consistently, they are recognizing the risk early, and they are making incremental provisions every quarter. So those could be reasons, because once you do once you write it off, then it will not be in your book, and it will not come in your PAR reporting and all those things. But this is I'm trying to say that because of the legal entity, there could not be any differences. But at the individual entity level, depending on the strategy adopted, the manpower or the various other factors, deployed or focused approach adopted, there could be, there could be improvements. Say, for example, some of the institutions have posted very low PAR numbers. So it is because of their focused efforts. But otherwise, based on the legal entity, there is no other than this write-off and other internal, the differences are due to these internal factors. Other than that, at the field level, no differentiation. Even banks also, if you go, they say, the group collection staff has come. In Tamil, they say Kulu sir has come. Okay. So we are identified as our microfinance team is identified as a microfinance company, not as a bank.
Sure, I take that. Thank you, Mr. Chelladurai. And I will very quickly move to Divya because I know she has a hard stop in another 15-20 minutes, and I don't want to miss out talking to Equifax for sure. So Divya, I just want to start by asking that what is the role of credit bureau or CICs in income assessment and indebtedness assessment requirement coming in from the practitioners, and how do you see this happening? And how you are trying to, and what are the kind of gaps and in the data that is being reported and that is being asked from you, and the proxies, that we can look at for more accurate assessment of the income and EMI obligations. So over to you, Divya.
Thanks, Purvi, and thank you for Sa-Dhan for having us here and having the panelists here and all the diverse opinions. So I'll quickly focus on the credit bureau aspect. We've heard of many other aspects with the panelists already, but I think the starting point is that in good news, a comprehensive view of the indebtedness of the borrower is available. And it goes back to your point, Purvi, where 10 years ago, when you all started at scratch, there was nothing available. Through the discipline of the industry, all of that data has accumulated over time. And today, a comprehensive credit report very much is available for us to understand where the individual has borrowed, both in the microfinance space, as well as their other retail loans or other indebtedness that they may have. Like Sadaf mentioned, we've seen many institutions very quickly move to pulling that comprehensive report, not just for the borrower, but for the family members as their policies evolve, as you define the family unit, who all you need to assess at the time of giving the loan. The uptake of pulling a comprehensive report is definitely on the rise, right? So a complete view of indebtedness is out there. On the microfinance side, EMIs are well recorded. We know how much is the outflow on the various frequencies that have been signed up. Retail still has to get there. Like Somesh mentioned right in the beginning, fill rates at the bureau for retail loans differ from microfinance loans. Maybe 1 in 3 loans, something slightly below that, will have an EMI value for the retail lending. The rest still need to be assessed and estimated. I think CICs as well as lenders themselves are putting into place estimation models till the data enriches over time. Given the experience, on this panel, on this webinar, it is possible to, with a reasonable degree of accuracy for many loan types, assess what an outflow would be, given that you know the tenure, given that you know the disbursed amount, the repayment track that has been witnessed so far. So that comes in as a stopgap arrangement till we actually start getting EMIs for everybody at a credit bureau level. So indebtedness is being addressed in that way. Income, like was mentioned previously, while the credit bureaus can capture the income that is reported to them, this field is very, very poorly populated. And in the past, depending on individual policies, depending on the rigor of the lenders, followed different norms. In some cases, it wasn't submitted at all to the bureaus. In some cases, it followed its own logic. You may or may not be able to rely on that number today. So we are also looking forward to, as all of these policies come in place, that data will start flowing in. I think what the credit bureaus will do, and what an Equifax report would show you eventually, is for the same individual who claims to be part of that same household, how different lenders have assessed their income. And if there is a wide disparity in what that reported income is resulting in, And that would go back to the points that the panelists made. It almost may become a self-check mechanism to see where tightening is required. If an institution is not asking the entire gamut of questions, that could be a good indicator that they're getting possibly partial information. And it will allow you to deep dive a little more when you see that in the report. If you see such a wide array of income for the same family, it's a good indicator to see that a little more time has to be spent to truly assess the income of that family. So I think in that sense, the combined credit information report is truly a comprehensive picture of a lot of the data points that you need. As this evolves and as lenders, lend more within this policy, as we start getting more and more data into the credit bureaus, I think the report will become more robust, given that the quality of the data will improve. And the checks and balances that lenders need to build to make sure that they are not inadvertently over leveraging a household, I think all of that data will be easily visible for them to take that call.
Sure. Divya, I'm sure many of us, including me, keep coming back to Equifax with every new requirement, and we need it as of yesterday. Everything that we want is as of yesterday with that kind of an emergency. So how easy or difficult it will be for, credit bureaus to cope up with that kind of a requirement, not only on the new requirements coming in, but I'm sure, as Sadaf said, that, every borrower, like earlier we were pulling out one report. Now for every disbursement, we'll have to on and average look at 3 credit bureau report at a household level. So typically, the volume will multiply by at least 3 to 4 times overnight, and with various requirements on the various data cuts and newer ways of adding the credit related things. So how credit bureaus are coping up with this?
So Purvi, I think honestly, the innovation is simultaneously at both our sides, right? While we absolutely have to cater to increased volumes, to possibly providing you summary views, aggregation views that you would look forward to ease your decisioning. Equally, it is at the IT end of the lenders to start consuming all of that information, right? We're integrated into the LOS. You need to now not only have rules that look at one report, you need to have them across. You need to give the due weightage to borrowers, to household members. So I think the innovations that we're all doing kind of are going hand in hand. As much as you want it yesterday, you also need to push your teams to consume it as of yesterday. So we're both struggling against time in that sense. That having been said, of course, we're constantly working to, as the regulation evolves and as we get more and more insight at the field level challenges, we're working to develop the report so that it's easier to consume. And, just as a very basic example, while EMI was already there in the report, now you just need to quickly know what the sum of EMIs is. It's right there. It should be the first field that pops out at you. So very quickly, within a few days of the regulation coming in, that was added into all of the reports. Reported income, while it was already there in the past, now it needs to be easily accessible. It needs to be right up there in the summary. I think these kind of tweaks are already in place. And that comprehensive view of what the household is, as you all define the household at the field level, we can put that household together in the report that we give back to you. So as you give us inquiries of linked individuals, our output will give you that summary view quicker and quicker for you to not have to look through pages and pages or fields and fields of information to make that decision. So I think we'll be partnering with you constantly to update at both ends so that this is a more seamless process.
Thank you, Divya. That is really, a good respite because, the kind of people, whether it is our customers or our people that we deal with. So we don't expect them to do a lot of data analysis and a lot of report reading. So, easier it is, it becomes much simpler for us to implement at a field level also. Absolutely. So thank you so much. And the other point is, and I'm sure a lot of people are asking questions. I already started seeing that in the chat box is about, while it is simpler to ascertain the obligation, because at least credit bureaus will report that there is no authentic way of assessing the income as we speak, because it is still here and say. So somebody can go with 20,000 and next day you can go and assess it at 25,000 also. So I think we still need to deal with one more, elephant in the room about how to assess the income more systematically. But thank you so much, all the speakers. I think we have done excellent on time, and we have a lot of questions popping up in the chat box here, and I'll take a couple of them and see if we can do the maximum. Yeah, so the question is, in our industry, proper income proof is not available. So how reliable is the income analysis? I don't know who would want to answer that question. Sa-Dhan, you want to take it? Yeah.
As a practitioner, see, the income assessment should be in accordance with your guidelines that you have laid down in your policy and which is approved by your board. I think that is what you should look at. I think accuracy of the income, because it's an income which is unsubstantiated in a sense, because there is a declaration from the customer, you can never be absolutely accurate. But what we are doing, and that is what I think some of the other people also are doing, is that you can have at least 2-3 references. So we are, one reference is obviously customer declared income. The second reference is, I think what Sachin also hinted was from the imputed margins. So in the industry, there are certain margins which are commonly noted. And you know that if the customer is in that business, she can't have such huge margins. So what we have done is we have bifurcated the customer category into 3, actually 4. There is manufacturers, there is traders, there are service industry and others. Obviously, on a trading industry, you can't expect a 50% margin. So you know that, okay, whatever the turnover she says, there could be a 10, 15 or maximum 20% margin. And similarly, I think on a service industry, certain margins you will come across. So those proxies you would have to build, but you would have to ultimately triangulate the income as per your board approved policy. That's my opinion.
I think I also remember Sachin mentioning about some MFI implementing that templated thing that, for if you're into cattle, these are the kind of incomes that one would get. And depending on the geography, that could be some variation. But typically, if you're in the same business or same occupation, then it will not be very different. So maybe, we can also look at templatized credit over a period of time once we have some more data and some expertise on that. Because I see a lot of questions in the chat box about almost similar questions as to how do we get proper income? Should you look at the land record? Should you ask for more proof of jewelry, other details and all? So there are a lot of questions. The other, I find one interesting question on the interest rate. And Mr. Mohan is asking that most of the MFIs will have to increase the interest rate due to increased cost of fund and risk premium, etc. Don't you think, again, there will be discussion regarding, serious interest rate? So I don't know who would want to answer that question. Mr. Shaladurai?
Yeah.
Yes, please.
Now, the RBI has now removed the interest rate cap. Okay, so earlier, anything beyond 26% is considered usurious. So there was a cap. So now there is no such definition. But instead, they have given a formula like, what is your cost of fund? Okay, and what is your risk premium? Okay, so you have to, so now, the credit cost is increasing. Okay, so definitely, every institution would work out, how much is the credit cost is we are incurring in this particular portfolio. So then that risk premium needs to be added. Okay, so accordingly we have to arrive at the interest rate. So earlier, because of this, 7, I think RBI used to publish a base rate, and based on which some formula is there, and based on which the interest rate has to be worked upon. But now we need not rely on that, but still we need to follow this protocol. Okay, but however, anything above 26, we should not go. So in my opinion, I think we should keep our interest rate in whatever circumstance is less than 26, within which we can work it out based on the whatever has been arrived in, through the formula.
If I can add to that, I think
Yes.
the thing that RBI has also introduced is that they would be publicly publishing the interest rates of the various entities which are operating in microfinance. So for NBFC MFIs, SROs have been given the responsibility, and for banks, RBI would be doing it through IB, or I don't know how, but there would be publicly published interest rates. So it's kind of a self-regulation. You would know that what you're charging, what your competitor is charging, and definitely nobody can be kind of out of whack when the industry is charging certain rates. I don't know about 26 is a kosher rate or a 27 is a kosher rate. It's a function of what your costs are and where you're operating, but definitely you can't be way away from what the other people are charging if you're in the same territory. And I'll go back to the same line, I think, which Purvi, you mentioned. I love the Marvel movie, and I think with great power comes great responsibility. So ultimately, we would have to be responsible, and we need to ensure that we don't charge usurious rates. That's what.
And also, you already shared in your presentation the components that you should consider while charging. So whatever you are charging, you should also have solid justification. I'm sure it should be well supported by your financials, whether it is cost of funds, your OPEX, your risk premium, and your expected return on assets. So it's a very well-defined formula. And yeah, but we will all have to have the discipline of things. One person not following is not, it's not going to be good for the industry. So everybody will have to be responsible enough. I will take one last question. How do you take the bullet loan, like gold loan, credit card, due, etc., into repayment obligation on monthly basis? Maybe Divya, you want to answer this? While I saw Sadaf, sharing the screen also and sharing the type of loans where it is difficult to get the EMI obligation, but maybe briefly you just want to answer that.
Sure. So there is a whole set of loans, right, where it is very, very difficult to assess what the monthly or the weekly obligation is for that loan. And, this includes all your overdrafts, credit cards, all of these loans. Lenders are, in our conversations, are adopting different strategies. I think whether they choose to club that together and uniformly take, a generic division of that over time to be conservative, whether their policies exclude certain types of loans when they're trying to assess the overall indebtedness, because for something like an overdraft or a credit card, it's very hard to pinpoint an amount that would be applicable. I think this is something that we will have to evolve over time. The market rates are known, but usage is dependent on the individual, and it would be very, very difficult to attribute a value to everybody. It may take people out of the realm of being eligible for a loan. So from our discussions, while there isn't any standard reporting on this, I understand that each of the policies that the boards are putting in place are allowing for this exceptional category and how to deal with it in a specific way.
Okay. Sure, Divya, thank you so much. I see a lot of other questions also, but I think these were the major three categories where related to income, obligations, and interest. I saw some questions. So we move to the next segment where we are going to be seeing some interesting presentation coming from Kaleidofin on the credit assessment tool. And I would like to hand it over to Sunit, Swati, and Kritika. So over to you, Swati and Kritika.
Thank you, Purvi, and thank you, Sa-Dhan, for giving us this opportunity to showcase a very relevant, critical changes that have happened in the regulatory field for MFI, in recognition of MFI being in the matured category, and how Chi-Score, which is our credit assessment platform, can be leveraged to address these regulatory changes. A very detailed overview was given by the panelists over here, Sadaf, starting with a very, very detailed explanation on the changes, categorizing them into where the problems are. I'm just going to share a presentation, and given the time, I will just quickly do an overview and then hand it over to Swati to straight jump on to some of the screens the kind of assessment that we do specifically on two key parameters that almost everyone today spoke about. Just sharing screen. I hope the screen is visible. Just a quick overview of Kaleidofin. We are a fintech platform that focuses on helping the customers, specifically in the informal segment, to achieve their goals using different financial solutions. It's been 5 years since we started, and a very integral part of Kaleidofin on the fintech side has been developing this credit assessment machine learning algorithm-based assessment decisioning tool that helps all the financial institutions with a very, very significant focus on the informal segment customer-based institutions, NBFCs, MFIs, small finance banks, and any other institution, how the platform can help in the deeper credit decisioning at per customer level. And with the kind of data that is already available with credit bureau, as Divya was pointing out, how the industry has over the last decade kind of got used to applying credit bureau as one of the critical credit decisioning parameter, and the kind of data that has been compiled over the last 10 years, we only see this industry becoming matured and getting to address any such new regulatory requirements that keep coming in more on the positive fronts. And Chi-Score has been live with us for like 2.5 years across multiple institutions. We have kind of underwritten about 6,500 plus crores of loans using the platform. Chi-Score basically kind of solves multiple objectives, anything within the credit decisioning arena. Today, I'm going to be focusing primarily on how this Chi-Score can address the specific requirements of the regulatory changes that RBI has brought in just about a quarter ago, and take you through some of the aspects in terms of how we differentiate in the industry by providing the closest estimation. As we all see, I'll be skipping a few slides primarily from the repetition perspective that it's already been covered, so I'm just going to be skipping. One thing that we saw either in Sadaf's presentation or Sachin's expert opinion and Cheladore and Divya's is that household assessment is the most interesting aspect that has come into this through this regulatory requirement. And on one hand, it's going to only better the whole credit decisioning and pricing the customers better. On the other end, how do we kind of assess this income, to be estimated to be right? Because end of the day, the segment of customers that we are dealing here, whether it's MFI or any individual loan into that 3 lakh category, are still not providing valid evidence, right? It's still a stated income. Still, how can we use this stated income on one hand, and of course with the other supporting data that is available thanks to Credit Bureau and the kind of compilation that they've been having, and they've been upgrading the authenticity of the data that is collected about this customer across different credit facilities. Chi-Score has been able to kind of develop a first version model for this particular regulatory requirement by triangulating. This is something which Sadaf has also mentioned. How can we, estimate the household, to the closest possible? It may not be 100%. Triangulation is the way forward. How can we help you triangulate this data, and how we have done it to see the authenticity as close as possible in terms of assessing this household level estimation. And of course, thereby as a result, how can we talk about the maximum indebtedness, again using the Credit Bureau data as well as the lender data. Today, as Sachin was also mentioning, each lender is coming up with a different questionnaire. Right? The key parameters RBI suggested, all of us are aware how to collect the information from the household, but each of the lender is definitely going to give certain importance in terms of how detailed this questionnaire is going to be, and the time that the field officer has. End of the day, the knowledge of the field officer and assessing how they are well trained in the market to assess beyond what is stated, what is actually the one which is representing is one knowledge, and how that knowledge of that individual officer's assessment is captured by that particular lender is where that maturity of that lender's capturing goes to. Of course, you have the other data that is available at a household level with this detailed CCI information report, talks about various other facilities. And we are basically bringing both into one platform and trying to triangulate with multiple iterations to come up with the most conservative, closest estimation. This is exactly where we focus. The third being the risk-based pricing. Chi-score by nature, by virtue of its existence, does the risk tiering of different buckets of these customers and gives you the pricing against each of these tiers. Each tier contributes a different riskiness and what should be the approximate margin that you'll have to add on as a pricing. So risk-based pricing is anyway a main product of Chi-score, and how we are going to be focusing primarily on number 1 and number 2 today. Just a summary over here before Swati takes over in terms of little detailed technical aspects. How we again do here is there are 2 key focus triangulation that we do primarily here is to arrive at the quality of living, which is via the questionnaire, and of course the data that is captured by the credit bureau in terms of what are the key parameters or what are the key features from these credit bureau data that is loaded on each of these customers. And how we take that is what we are going to come up and show you to you. There are 2 different models we come up with, and then we come up with a consolidated approach to identify and estimate the household level income estimation. We are also planning to show you a little bit of screen how this whole questionnaire demo also comes through our models. Looking forward to Swati to now take it over from here to explain a little bit detail on the technical aspects so that we can kind of cover this. Over to you, Swati.
Thank you, Kritika. So I'll reshare my screen. Okay. Participant screen sharing is visible. Can I? Can someone give me access to sharing screen because I don't have it?
Yes, one.
Yeah.
1 second, Swati, just doing it.
You can share now.
Okay. Please let me know if it's visible.
Yes, it is visible. Sorry. Go ahead.
So as Kritika said previously, we are first estimating the income based on some set of questionnaire. I'll directly take you to the questionnaire that we have. So this is a demo of the questionnaire. A lot of the people here must be familiar with it because it's actually what was proposed by MFIN previously. So we have the profile information of every single earning member of a family, a household. And as said previously, we are also considering a household to be the spouses and the unmarried children. So all the earning member details, and moving on to the KYC details, all the details, personal details of a family's earning members. That is what we consider profile, their personal information. Next, moving on to the profile information, here we consider it as household asset profile. By asset profile, we mean the composition of a household's assets. That is, if you, how many members, earning members do you have? How many dependents do you have? Do you have people aged more than 60? Do you have children going through education? And after that, we also have, okay, yes. Here we also have information on accommodation. If you are staying in your own house or are you staying in your rented house, if your house is concrete or kacha house, what kind of, do you have a private toilet? Are you still using a public toilet? Do you have electricity, water connections? Do you personally own any agri land? Do you have any other land except the one you are staying in? Are you giving your house, do you have an extra house that you're giving for rent? Do you own a shop? All these kinds of information are again being taken into consideration. We are also taking it's not just an yes and no based one. We are taking into consideration the value of the land also, because that might also indicate a household's income. We are taking into consideration their vehicle, what kind of vehicles they use. Do they use smart TV? Do they use a telephone? Do they have a smartphone? All kind of asset data that can be taken by a field officer in his field visit and can be verified by him. So all these kind of data is being considered. This is not a static set of questions based on partners and based on different location and regions. This set of question can be easily, it's flexible, so it can be easily modified. You can add more questions, you can change the language, you can remove certain questions, because to some regions, some locations, maybe like south of India, having an electricity in every single household is common. So that is not a necessity for that set of location. So we can remove that. Then we have, as we said, the income information of every single earning member of a family, and that is self-stated. So here we have all, we are considering that you might have more than one income. You might have a regular income, you might have a secondary income from your other businesses, and that is taken into consideration. And other source of income which can be taken as, say you can have a pension, or you can be given money by someone else, or those kind of income also can be stated. Yes, people might not agree to stating it, but we have kept it as an option that you can state your other set of incomes that is coming from elsewhere, not from your regular jobs. Then we have the expense. So here we are taking into consideration some regular expenses, like if you have dependent children, then their education. If you have dependent parents that are more than 60-year-old, then their medical expenses, your clothes, electricity, gas bill, all these for transportation, entertainment. If you have, then we have the irregular expenses that you might have over 1 year period. You might have sudden medical emergency, or weddings or functions, or certain education needs, or house renovation. All these kind of information is kept. So all these data we are taking. So this is just the data that we are capturing in the questionnaire. Then after this questionnaire is done, which agent goes to the household and then gets these data, we are instantaneously from the first set of data that we captured, that is the personal information of all earning members, we do a credit bureau call, and instantaneously we get the credit bureau report. And then what we do, I'll move on to the slide to show. As mentioned previously, the most important part is triangulation. So that is what I'm going to base this on. Here is a proper workflow of what I just said. A MFI officer is supposed to go to a household. He'll help the people fill up the survey form. After the survey form is done, instantaneously a bureau call is being triggered. And from that, we are moving on to the chi-score reg model that our algorithm has. The output of that, is the household income that we are estimating, the max debt capacity of that particular household, the current indebtedness that this household has, and what available debt service that they can give. So how much monthly EMI they might be able to pay. So these are what we are giving up. And just move on to the triangulation. As that's,
in fact, even on the questionnaire, just to add, as she said, while the modification is possible, we can kind of, through the web link access with the partner, add on their question also. We can do a consolidated questionnaire to ensure that field officer is just meeting once to collect all the information. This not necessity that you have to use only mine or yours. We can combine and get the detailed assessment done as much as possible.
Yeah. So on the triangulation part, there are two major ways.
Swati, sorry to interrupt, but I think we'll have to speed up a little just to be on the time, and we should also be able to answer some questions if
Sure.
Some of our participants are interested in knowing something more about.
Sure. 2 minutes, Purvi, this will be done. This is
Sure.
last slide. Yeah.
Sure. So first, this is the major set of triangulation that we have. One is here we are calculating a household living index score. So the living index score is calculated from the household assets that we have. We are giving each asset a set of weightage. Like if you have electricity, let's say you have a weightage of 2. If you have a 4-wheeler, you have a weightage of 4. This is again flexible. So all these assets that I showed you in the questionnaire previously are being given a certain score. And then from that score, from 0 to 100, we are scoring a particular household. According to the assets that you have, what score that household will fall in. Similarly, on the income category that they have self-stated, self-reported income, we are also making a bucket. So let's say the household's total income as per their self-stating is something like 2 lakhs. The whole income is. So by our method, what we are saying is we can put the 2 lakh income as a high income, a medium income earning household. So if a medium income earning household is actually having a living index score as medium, that is fine. That is what we are considering as what should be. You should have the similar set of bucketing in both the cases. Living index score and your income index score should be same. Now, if that is changing, if that's not same, if you are coming as, if you are in the living index score, you are coming as high, but in the income index score, you are coming as medium, then it is possible that you are understating your income. So that is why that is why these set of customers need to be rechecked. On the other hand, the other way around is also possible. That is, your living index score is low, but your income index score is high. That means you are possibly overstating your income because you want to fall into the less than 3 lakh bucket household. So that is also a possibility. So these two kinds of household we are trying to find out, and we can go back and make a check on these particular households. On the other households where both the buckets come as same, then we can safely assume that their income is to a certain degree, to a margin of confidence, correct. Now, the second kind of validation that we are doing is from the credit bureau data. On the credit bureau data, we have previously, whatever loans a household has taken, all the earning members of that particular household has taken, we have the data of that. So from that, we can take into consideration what kind of monthly EMI they have been paying historically as a household. And we can calculate or take a small guess that twice into 12, as in a monthly EMI. So monthly they'll be paying how much, multiplying into 12 is yearly EMI, how much they are paying, and into 2 can be taken as the minimum income of that particular family annually. That is a minimum cutoff we are keeping. So if the income of that family is coming as more than that, then it's fine. But if it is less than that, then we can consider that that particular household is understating his income, because already he or that particular family historically has paid more than his income is signifying in a particular year. So these are two kinds of triangulation we are doing. We are also doing a similar kind of triangulation in the indebtedness, where we are calculating a maximum indebtedness. And if the particular his indebtedness is more than 50% from the previous credit bureau data, then we are considering him as not a valid household to give loans. Kritika, I'll hand over to you.
Yeah. So that's precisely how we do the triangulation. I know within the short term, we may not be able to show the nitty-gritties of the technical aspects. We are always available, say, via Sa-Dhan, or we can leave out coordinates over here. We can reach out and do an individual check with the respective institution, whoever is keen on working on this. This is a version 1, and this is only going to go better as we, start seeing the modern results and evaluate the, score that is coming.
Sure. Thank you so much, Kritika and Swati. That was very helpful. It would be good if you can share this presentation with Sa-Dhan, and then, whosoever wants it can take it from Sa-Dhan or whichever ways you want it.
Sure.
I would just, we can take some questions from the participants if they want to ask anything to Kaleidofin on this. I don't see any question right now. If anybody wants to ask the question, we can take a couple of questions. Okay.
Purvi, good evening. This is Mujahid here.
Yes, Mujahid.
Purvi, I have one small clarification. Since after the new RBI guidelines coming in, all the companies have been given the flexible interest rate charges. So just wanted to understand, saying that this flexibility is given to the lender, or it is decided by the RBI, saying that you have to charge like that. So my question is, take an example, I am a XYZ lender. Okay, RBI has told me to charge below 26%. So now is it my responsibility to charge anything, or I can keep it from flexible from 18% to 24% for a different users? So I want clarity related to that.
Okay, so Here, I understand lender as any regulated entity. So it could be NBFC, MFI, or Section 8 company, or
Correct,
all the
correct.
regulated entities. So RBI, as Sadaf was explaining in his presentation also, it is up to the lender or the MFI to decide what rate they want to charge. RBI has not given any specific range that you cannot charge below 18% or you cannot charge above 26%. But this has to be a board approved policy, which should be displayed in public domain. It needs to be reported to the SRO, and if you are being questioned on that, you should be able to justify as to what rate how you are charging this rate, because this rate is a combination of 4-5 things, which is your cost of funds, your operational expenditure, your risk premium, your expected return on assets. So it's a combination of 4-5 elements, and you should be able to justify that. And RBI does not say anything minimum or anything on maximum as well.
Thank you so much, Purvi. Thank you. My question is answered. Thank you so much.
Thank you so much. So I don't see any question coming up. So over to you, Somesh, for closure remarks.
Yes, thank you, Purvi, and thanks so much for a wonderful moderation in your characteristic, very lively and fun style, and putting all the relevant points. And I'd like to thank all the panelists, Sadaf and Mr. Chaladurai, Divya, Sachin, and also to the two presenters from Caledocin. So thank you for, I think it's been a very timely session as these regulations are rolling out, and this topic was really the need of the hour and what members are saying. We will be sharing highlights of this presentation to the others, including and any questions which have come in which you feel have not been answered. We'll take another look and get them answered, because I know there were a few questions there. There's also Google form which was put in, so please do share your feedback. We always want to make these sessions better and better. And until the next topic, we hope to see you again. But thanks again to all of you for your valuable time and wonderful suggestions. Thanks a lot.
Thank you so much. Thanks a lot.
Thank you.
Thank you. Thanks for the opportunity. Thank you, everyone.
Thank you, everyone.
Thank you.
Good day. Bye-bye.